Hello and welcome. Thank you for tuning into our live stream today. I am here with Aaron Hill, an experienced trader and market analyst here at FP Markets. Aaron specializes in technical analysis and derivatives trading. Thank you for being here, Aaron. We appreciate you taking the time to answer a few short questions for newer traders.
No problem at all. It's a pleasure to be here. Thank you.
So to start, how did you get into trading in the first place?
So my journey began almost, I think it was about 12 years ago, I believe, and initially kicked off in the equity space. I was introduced to stock trading by an old colleague of mine who was and still is swing trading equities. Look, he lent me a book titled, I believe it was titled Trend Trading, and I know it was written by Darryl Guppy. As you can imagine, it did not take me long to finish, and by the time I did, I was hooked. So I read anything I could. Literally, following that, I read anything I could get my hands on. Meanwhile, trading stocks with real money, which, as I'm sure any experienced traders will know, was a big mistake. Anyway, fast forward a year, I was fortunate enough to meet a couple of guys who had been in the business, who were in the business for years, but were trading foreign exchange, and this was, of course, new to me. But I often say I had two mentors, but one was more active than the other, and he kindly coached me for free. I know now how fortunate I was. And yes, so that's really where my journey into the, shall we say, the wonderful world of FX trading began.
Thank you. Do you think that anyone can trade?
Trading is a business where barrier to entry is low, but while literally anyone who understands the basics of a computer and has a small amount of spare cash can engage in the markets, many do not realize the commitment required to become a success in trading. I guess you could say this about any business, though, right? So look, to answer the question as to whether I think anyone can trade, I do believe they can, and this is a very big but. They need to be willing to sacrifice the time to learn, and essentially be willing to change, or should I say adapt. What I mean by this is one's mindset. So to trade, you must accept that losses will occur and you'll be wrong at times. Just to give you an idea for any newer traders present, this is a double whammy of hurt for many of us, and can really be detrimental to one's psyche. And can lead and can ultimately lead to things such as revenge trading.
What personal aspects do you think are helpful to those getting into trading?
So I guess you're referring to more personal trades, right?
Yeah.
Yeah. Okay. So look, a big one for me is patience. It's key to stay. It's key to staying consistent and executing trades based on your trading plan. Patience is what stands between, for me anyway, patience is what stands between frustration and joy, as well as failure and success. Discipline is another key personal trait, I believe. I've always considered myself a reasonably disciplined person, so this was somewhat easier for me. Having the discipline to follow your rules of engagement and also respect risk and money management rules can obviously make or break a trader. Another one is mental toughness. Trading is unfortunately not just it's not just about netting winning trades, or as some gurus may have you believe. Consistently profitable traders have losing trades. And many of them, but they know they have developed a trading mindset to adapt and bounce back after losses. If you're down after each loss, life will be pretty miserable. So look, there are others, but I think this may be enough to address that question, I hope.
Yep. So what were some of the biggest mistakes you made when you started trading?
Well, good question. I made plenty of mistakes when I first began trading, and and I still do make mistakes, but less now, more. Less mistakes are made now as I gained more experience, thankfully. A personal mistake of mine was not listening to my mentor enough. He would continuously speak about risk and the importance of thinking, like a risk manager first and foremost. I never took risk seriously until I was almost forced to by losing a considerable amount of capital within the space of, I believe, it was a minute or two. Another mistake was repeatedly changing my strategy only after a handful of losing trades. I'm sure many newer traders will acknowledge this. This also goes hand in hand with my lack of backtesting, which was another a big mistake. I can remember to this day how frustrating this was. Not to mention tiring. I would also, I would change this to one method, trade it live, and have a few losses and then give up. Altering trading strategies after only a few losses is a painful process. How I was able to move on from this and stop making the same mistakes over and over was, of course, listening to my mentor. That was first and foremost, who said a back test was paramount. Then following the back test, then either a paper trade your system or your idea, or trade it with a small live account. As this includes more of the psychological elements related to trading. So basically, I needed to give the method more time to prove itself. Look, taking only five trades does not prove anything. For me personally, I would aim for at least 100 trade samples, excuse me, in the back test, and then at least 30 trades in demo or a live setting before you have an idea of how your idea or your system performs. One other mistake was not focusing any energy on my mindset. The psychological elements of trading is huge, But look, maybe I should wrap up this up here, as I could talk much more on this. So that were my three main mistakes.
Okay. So you talk about mentors. Do you think new traders should look for mentors? And if so, how should they find one?
So look, I firmly believe a mentor can most definitely accelerate the process of learning to trade or invest. Learning from someone that's been there and done it, and importantly can prove that they've been there and done it, because there's a lot of traders out there that say they're doing it and probably not. So look, do I believe you need one to be successful? No. However, many lack the discipline and willpower to learn this business. So that is where I believe having a mentor may help, may keep you on the right track and lift you when you're down, sort of thing. But the key question is, look, how do you find a mentor that is truly going to help you? Ideally, you want someone, as I said, who's been there and done it, a mentor with proven success in the field you're interested in. So if you're interested in trading FX, someone that's predominantly trading FX and for a consistent amount of time. And look, the only way to ensure this is a mentor who's willing to prove to you they trade. Being open about their accounts is, for example, is a very good one, but not many are going to be open about their accounts. And that's just the way it is. While there's many who claim to be mentors online, or dare I say the word guru, many are just trying to sell a course, I feel, and I'm sure this may annoy some people when I say this, but this is really what I've seen over the 12 years I've been involved in the business.
Thank you. So what tips can you give on managing trading psychology? Okay,
so look, with trading psychology, I believe while some do say you can remove emotions, I believe it's impossible to remove the emotional aspect of trading, particularly if you employ a discretionary-based strategy. Automated trading, or sometimes referred to as non-discretionary systems, are better placed to almost remove emotions, but still, users of automated systems can and do fiddle with their parameters at times influenced by emotions, obviously. So as for what tips I can give to help manage trading psychology, my first and most obvious would be to educate yourself on the subject. A personal favorite book of mine is Trading in the Zone. I've mentioned this countless times in previous webinars, by Mark Douglas. He writes in an easy to read, a simple fashion that most can grasp, and it really opened my eyes to the world of emotions and trading psychology and how important it is in trading. Another thing I would add, which I guess you could say is easier said than done, is to embrace and accept risk. Many unfortunately pay lip service to this, but few actually follow it. A good example of this, is say a long position on the euro dollar with a protective stop loss order of, say, it doesn't really matter, 35 pips away. The trade dips into negative territory and is on the verge of hitting the stop. In this situation, some traders will alter their stop by moving it lower and thus increasing risk, obviously. This is not accepting risk. Look, although trading strategies are important, are crucial, in fact, I feel trading education not so much sidesteps the psychological component, but almost glosses over it and certainly does not emphasize it enough. Look, for any newer traders watching or will watch this recording, do not make this mistake. Trading psychology is a vital part of trading consistency and success in this business.
So why do you think most traders lose money?
That's a good question. There's a truckload of reasons, I believe, for this. But look, I think it's something like 70% of all retail traders lose money, right? I'm not sure of the time period in which they lose money, and and shall we say throw in the towel. But there's clearly an issue if 70% are losing money. Personally, I believe the main reason many lose is because trading, it's a skilled profession, requiring various skill sets to reach consistency. I do not think traders realize this when they first begin their journey. Unfortunately, it's not all about charting your favorite patterns. There's rigorous backtesting to consider, risk and money management principles to adhere to, and of course, as I said, one's mindset. Look, you almost have to change the way you think, which excuse me, which you will read a lot in the book I just mentioned, Trading in the Zone. Look, what I just said may come across as harsh, and I apologize for that. But often trading decisions are not based on trading decisions are not based on research. Oh, sorry, look, I'm just trying to think of the way I could say this. Often trading decisions are not based on research or back-tested methods, but emotional direction, or worse, the need to entertain a gambling addiction. Look, if you do not take anything away from this, other than this, please do not treat trading as a hobby or a game. I say it often enough that trading is a serious business with risk involved. So please treat it as such, and results will or should improve.
How much capital do you think is required to be a successful trader?
Well, I'm not sure, the amount of capital required is ultimately trader dependent. And also, it depends on the markets you intend to trade, right? Being undercapitalized is an issue I see with many traders. It's almost laughable. Traders desire an income stream, but are only willing to invest $500. I mean, it just makes no sense at all to me. We have to be realistic. Since very few, and consider this: since very few are patient enough to let their account grow, they'll risk far too much of their capital, the $500 on each trade, trying to make that income they have in their heads, and in the process they'll lose everything. And I believe this is likely a big contributing factor to why so many lose in trading as well. Look, for forex trading, assuming most follow a conservative risk profile of 1 to 2%, I would suggest at least, for me personally, at least 1,000 to 2,000 US dollars to, shall we say, get your feet wet. Once comfortable with this risk profile of 1 to 2% on that account equity, you can then think about accounts of 5,000 or even 10,000 in account equity.
What do you think the benefits of trading derivative contracts over the underlying asset?
So, look, derivatives can be, as I'm sure most of us here understand, derivatives can be created as standardized instruments or derivatives exchanges, or on derivatives exchanges, excuse me, or as customized instruments in the over-the-counter market. Look, I think there's a truckload of information on the internet regarding this, but off the top of my head, the benefits of trading derivative contracts over the underlying asset, is access to leverage. It's a big one. Leverage, leverage in the right hands can be incredibly powerful, but in the wrong hands, of course, it can be devastating. The ability to buy and sell markets with ease is another one. CFDs, or contracts for difference, are designed to mimic the trading their underlying market fairly closely. This means you simply buy and sell CFDs as you would the underlying asset for a fraction of the cost, which is the initial margin. Also, another one is hedging risk exposure is another clear benefit, which I believe was and still is one of the main purposes. Since the value of the derivatives is linked to the value of the underlying asset's movement, it's easy to see why many will use derivatives contracts to mitigate risk. So yeah, for me, Gabe, they're the three main benefits off the top of my head.
Right. How do you view leverage, and how much should newer traders be using?
Oh, leverage is a good topic. My initial thought on leverage is traders, they commonly misunderstand what leverage is. Leverage is a fixed ratio fixed by your broker. Leverage also works closely with margin. In fact, your leverage ratio governs the initial margin. So, for example, look, 100 to 1 leverage means 1% margin is required to trade. I'm just trying to give you an example here. It's therefore important for you to understand position size as well. So, look, a mini lot or 10,000 units would equate to $100 margin required at 100 to 1 leverage, because that's at 1% of 10,000. So look, maybe I've just confused a load of newer traders here, but so look, when you read higher leverage is bad, you might want to think more about it like this. Say we have, I'm just trying to think of an example, 500 to 1 leverage, which 1 divided by 500 is it gives us a 0.2% initial margin. So this means that on the same 10,000 unit 10,000 unit trade I mentioned a second ago, this will only require $20. The issue with this is the higher leverage rate and the lower initial margin. The issue is the trader has more free margin to trade, and therefore can potentially tempt newer traders, especially, to take on bigger positions, because they have so much more free margin to play with, and this can ultimately wipe their account. Look, I hope this explained part of the question, how I view leverage. As for how much leverage traders should use, this is largely down to the individual trader's risk profile, and it's very difficult to generalize, but yeah, so I'm not really sure on that one, to be honest. There you go.
Okay. So your specialty is technical analysis. Why did you choose that for your trading? And why would others use the same or different types of analysis?
Oh, I cannot really answer why I chose technical analysis. Look, to be quite frank, it was a long time ago, and I do not remember the reason. All I can think of is my mentors. Were primarily technically based, so it was. At the time, it was probably an easy transition for me to make to follow in their footsteps, right? It's very unlikely I'm going to choose fundamental analysis where my mentor trades technically and is making consistent gains. It just made sense for me at the time. As for why others may choose technical analysis, I would probably say that is due to the amount of attention technical analysis gets over fundamental analysis, especially on the internet. It's just technical analysis it floods the internet. However, I have to be clear, I truly believe a mix of fundamental and technical analysis is best. Fundamental analysis, as I'm sure most traders here will know, it helps govern the long-term direction, and technical analysis helps control entry and risk. Look, I always think of fundamental analysis as providing the why of a trade, and technical analysis provides the when of a trade, if that makes sense. When to trade, if that makes sense. So the technical analysis helps govern the entry. Okay.
Yep. How do you choose which instruments to trade?
Oh, selecting the right instrument to trade is a good question. As I'm sure we're all aware, the financial markets is made up of hundreds of instruments across several asset classes. Each different type offers traders the opportunity to take advantage of price movements and to potentially make a profit on their investment. There's a number of things to take into consideration, things like volatility, liquidity, transaction costs, margin percentage, and time of day. Look, I've only really ever focused my attention on foreign exchange over the years, so this is where, if it's okay, I'll direct my answer. Look, as FX is a decentralized arena and runs largely 24/5, the time of day is an issue you would need to take on board. Trading sessions like Asia, London, and New York are important to be aware of. In terms of what currency pairs you choose to trade. The best time of day to trade Forex will obviously, as I said, will depend on the currency pair and also the type of strategy you use. So look, typically there isn't much movement during the Asian session, and favors range-based traders. When London gets underway, this is when more liquidity generally enters the markets. Breakout strategies can be employed as I just said, volatility and liquidity picks up. Currency pairs such as euro dollar and pound dollar also tend to see the greatest activity during London and New York hours. Around 12 p.m. UK time is when we see the US markets begin, but the cash markets don't open until, I believe, 2:30 p.m. UK time. Look, it's also wise to note session overlaps, of course. So, for instance, the London NY session overlap, I believe this is largely, as I said, largely when the US cash markets open. I think that's between 2:30 to 4 to 5 p.m. UK time. Look, I hope that answers the question regarding which instruments to trade. It can be very difficult, but all I would say is it depends on the time of day. And as I said, there's a number of issues like volatility, liquidity, and transaction costs and things like that.
Okay. So you're a discretionary trader, obviously. What is your view on automated trading strategies?
Oh yeah, I don't have much experience with automated trading aside from what I had to research during my CMT exams, and that really opened my eyes. By the way, it's incredible the amount of work and effort that goes into creating a system algorithmically. But overall, I do know traders who generate consistent revenue using non-discretionary solutions, and I do like the idea of largely removing the emotional aspect. But look, I can't really comment on my view is, as I said, look, I like the idea of largely removing my emotions, but I've over the years I've stuck with discretionary trading, or partial discretionary trading, should you say? I guess you could say. So that's all. I don't really have much of a view on it, to be honest, other than what I've said.
Okay. So how do you measure your success as a trader?
Well, how do I measure my success? Look, I'll go over a few different measures that I know traders can use to measure, especially trading performance. Look, a common one is by what's known as benchmarking. It's very common. Look as an example, for large cap equity traders, the S&P 500 is a common benchmark to compare performance. Watching the equity curve of your account is common, but I would always advise traders to also calculate what's known as the MAR ratio on top of this, which is a ratio of net profit to maximum drawdown. Net profit is obviously the difference between the gross profit and loss of your trading. Look, and a ratio of a MAR ratio of greater than 1 is preferred. Look, as an example, imagine a 15% return, which is divided by a maximum drawdown of 10% of the system. This will give around 1.5. So, as I said, greater than 1 is preferred. Look, other measures, of course, are profit factor, which is simply a ratio of gross profit to gross loss. Outlier, adjusted profit to loss, is a good one. Which is basically, it's adjusted for the largest profit. Additional measures, you can use are the win rate of the system. The payoff ratio is another one. This is a ratio between the average winning trade to the average losing trade. For trends, in this example, for trend following systems, this should be ideally above 2. So just as a quick example, so if we win, say, $400 on the trade, and then we lose $200 on the trade, this will give you an average. On average, that is, this will give you 2, and it should always be above 2 for trend following, as I said. Look, of course, there are other ways of measuring success. For me personally, I do like the MAR ratio. And I'm pretty simple. I look at my win rate, and my win-loss ratio is another one. My average win, my average gain to average, my payoff ratio as well, things like that. So yeah, there's a number of things I look at, but what I've listed, I believe, is most common.
Okay. So to finish up, what books would you recommend for those interested in trading? I know you mentioned a few before. Yeah,
look, I would obviously recommend Trading in the Zone for those looking, as I've already mentioned, for those looking to increase their knowledge in trading psychology. That was written by the late, as I said, Mark Douglas. Look, there's a great interest in Fibonacci trading. I do analyze the markets with fibs. Things like expansions, extensions, and things like that. And there's often a lot of confusion about this. So a good book I would recommend is Fibonacci Trading: How to Master the Time and Price Advantage. It's written by Caroline Baroden, I think her surname is. So look, and this focuses on things like retracements, extensions, for example, and it's really well written, very similar to Trading in the Zone. Another book you could almost consider an extension to this is Harmonic Trading, written by Scott Carney. I believe harmonic trading is somewhat complex. It's more complex than the basics of Fibonacci. Harmonic patterns are essentially a display of price structures and Fibonacci relationships. look, finally, for risk management, I largely took most of my study from on risk from the CMT program. So I couldn't really comment on a specific book. But for money management, I would recommend a book written by Ryan Jones called The Trading Game. So they're the only 4 books I would recommend.
Okay. Thank you again for your time, Aaron, and thank you to everyone who tuned in to listen. That's it for today.
All right. Thanks, guys. See ya.
Thank you. Bye, everyone.